sometimes you have a choice, most often you don't. I had no choice but to grow up in a dilapidated, bombed out, post-war, World War II Germany. And that's probably why I early on, already as a child, developed a curiosity for what other places looked like. And I started, as soon as I was a teenager, I started to hitchhike through Europe and ended at the Channel. And it was always my desire to get into Great Britain, which I finally succeeded to. And of course, I ended up in trouble. The trouble was that I got engaged to a girl that was even younger than me. I was a first-year psychology student, and the family was desperate. First of all, I was a German at that time that had a different connotation, but much worse, a psychology student. And so they thought the risk-reward, that really doesn't work. There's a lot of risk with this guy and very little value add. And this is how I found the mission of my life, because from that point on, they succeeded, by the way, to separate us. From that point on, I tried to prove them wrong. And I would say, partially at least, I succeeded too. But as you have noticed already, the core part of risk assessment is also time. You might assess certain risks that are absolutely equal differently on a scale from 1 to 10. You would say this is a 1, and on another situation that is virtually identical at a different time, you would say this is a 10. So be aware of the fact that some psychological phenomena also materialize in investments. So some things, a few years ago, you said they are 10s as far as risk. Today, probably you would say, well, it's probably a 3, and you are going to do things that in other time periods you would have never even considered. One of the interesting biases, that's what this is all about as far as my speech is concerned, is actually this home bias that happens when something dramatic occurred, like the 2008 recent meltdown of the markets, and then people say, oh God, the rest of the world doesn't exist. The only thing that is important and is close to me is my home market. And that always happens when there's a high perception of uncertainty. Right now we have an interesting market too. We have enthusiastic real estate development in many places. We have new record highs at the stock market. And right now we have a different bias. It's an action bias. An action bias you can have at home and abroad. You can have it anywhere and everywhere. So I think I heard before one of the speakers said, we got to do something, because if we do nothing, look at the money we lose. That is probably a painful thought, but probably you also don't lose it if you don't invest it. But from afar, foreign markets appear more promising than they really are. And our company, as you might know, is active on 3 continents in 11 markets, and I can tell you these markets are all much more complicated than we wished. You have recently seen a Nobel Prize being split up because nobody really knew which of the models is correct, and they're conflicting and even contradictory. So they gave the Nobel Prize in 3 pieces. One of the winners was Eugene Fama, and he proposed diversification as one of the main ways to avoid certain risks. And that diversification, this is your job, Dr. Strive. I have, as all good Germans, a technical assistant, Dr. Strive. and he has a doctorate. By the way, very few people know, it has nothing to do with this thing here, but 40% of the SS and SA leadership had PhDs or higher degrees. I don't know why it came to mind. So anyway, diversification in investment is more complicated than it looks, and it is even more complicated in real estate markets, and that's what we unfortunately have to deal with, because we are not smart enough for all the other liquid and much nicer asset classes. So we have here a agenda, and the home garden, I recall from my relationship with this beautiful girl who then married my best friend on top of it. Anyway, I'm married for 37 years to a girl from the Upper East Side in New York, so I stayed with the international program. But this girl in England, she had a goldfish in a bowl just like that, and she also had a cat, and I almost would say it's the same cat, and she did not look like that girl on the right, but I thought for variety, here's another option for a broad bias. Let's talk a little bit about the action bias. We still have 24 minutes, that's longer than I thought. But action bias, you realize how important it is to do something when you feel that there's a little tension. And imagine yourself as a soccer fan or even a soccer player, and you have the penalty shot issue, and there's the goalie, and that's you with the ball, and you go through all kinds of algorithms what to do, both the player that has to shoot the ball but also the goalie, and the goalie has only 3 options. He can stay put, he can jump to the left and to the right. These are 3 options. There's 2 minor options. You can jump forwards and backwards, but backwards particularly is not a good idea. But this is very, very important for you as investors to understand, because the correlation between whether he jumps or not is not particularly high as far as shooting goals is concerned, but the correlation between how he experiences the action is totally different. So if you don't move and the ball goes in the net, it's much more pain than if you did something. And this is really what very often in the investment world, this is what we do. You know, it's just too painful to do nothing because everybody says, hey, man, wake up and do something. We have to see that this so-called action bias, by the way, the study with the goalie is a study by a group of Israeli psychologists. If you're interested, you should read it. Dr. Strivi can give you an abstract on it. Anyway, along these lines, as I said, investors and managers follow similar patterns as goalies. In addition, there is a natural tendency to extrapolate past and present developments. So if you in the past jumped left and you were successful, chances are that you will intuitively jump left again, because you correlate past experience with future events. And pretty stupid, isn't it? But we are, unfortunately, created that way, and there's not much we can do about it. It's actually not stupid, it's normal. Stupid is normal. Institutional investors, it has nothing to do with what I just said, in the US follow an aggressive strategy to buy up everything right now. This is also a certain bias. Finding inventory is the current name for it, and players such as Blackstone and others are leading the game. So as a result, for example, home ownership rates have decreased significantly. Private buyers hardly can find a house to buy because the institutions buy up all the housing stock in the United States. And if you go to an auction, you might encounter 20 or 30 competing bidders, so the auction price might be higher even than the market price. And this behavior results in faster increasing sales prices than rents. And that's always interesting in real estate. When the prices go up and the rents stay pretty much the same, you can almost predict what will happen sooner or later. Our next bias is a beautiful one. It's the so-called abroad bias. This is my personal bias because I really believe in doing things abroad without giving up what you do best at home. Investors are jumping often on a moving train to foreign markets, and they buy assets that they don't know. And that is often a result because the returns in the home markets are so disappointing that this is the reason why they go to foreign markets. And that's not a good reason for doing that. The grass seems indeed greener in the other gardens. Even so, I must admit, when I first hitchhiked from Germany to England, I'd never seen green like English lawns. It is really something. And again, this morning when I flew in to look down there and see that green, this is so special. And that girl also in their front yard, there's unbelievable green. You should see mine. It's not so green. Anyway, the belief that the grass is greener on the other side of the fence induces an abroad bias, neglecting one's own expertise and knowledge about the home market. Allocation abroad is essential to risk reduction, but excessive allocation to foreign markets may overexpose to unknown risks and uncertainty. My advice is to avoid overconfident extrapolations and cluster risks, and also be aware that listening to your gut feeling can mislead you, because the gut quickly adapts to new circumstances. The gut is nothing but 1 or 2 pounds, depending on your body weight, of bacteria. So you go to a different place, eat different food, you get different gut. Gut feeling. So gut feeling is probably useful in selecting your romance partners, but mine wasn't too effective as English guts. But in real estate, you should probably use other ways to assess risk. The next slide, please, Dr. Striebe. Threats. Now, as you see here, the cat is obviously the threat. And the goldfish is in a very safe environment because the cat hates water and the goldfish hates air. So usually they stay separate and there's no problem. And that's a typical investment situation, that you don't do things that you are not comfortable with, particularly if you look around a little bit and see how dangerous things can be, like corruption and currency fluctuations and cultural issues and. So, but strangely enough, in many biotopes, particularly in the human realm, these fish start to jump. And threats are not only caused by irrational and biased behavior, but they can be found intrinsically in the complicated nature of real estate investment. So making a real estate investment in itself is a very daring undertaking. There is an intrinsic threat that something could go wrong, and that this cat, while you're in the early stages of your project, probably grabs you before you have enough experience to feel safe in the water again. However, the heterogeneity of foreign markets involves not only real estate risks, it involves some other risks that are even more difficult, and that's the legal risks, business method risks, to be kind, and different investment models, which very often have the same name, but it's like car. And the one guy is driving up in a car that's called Porsche, and the other one that's driving up in a car that is called, I don't say what car it is, but another car. So, of course, you quickly realize that there are interpretation risks, not only in the verbal, but predominantly in the non-verbal communication if you invest abroad. Let's look a little bit how, with all that scary stuff and all those various risks we had, if you remember the so-called home bias, we had the action bias, we had the abroad bias, and there's a few others. Actually, there are biases that are also prejudices. Just yesterday, we spoke to a highly intelligent chemist in Germany that invented some pill that now is sold by a Swiss pharmaceutical giant, and so as a result, he's a billionaire. And one would think that a person with that type of background and education would be free of prejudice, but believe me, prejudice and intelligence also don't correlate very highly. So what the specific person said about certain people in certain parts of the world indicates that prejudice can also be a positive. It's a protection against the unknown. If you call it bias, that's probably a little less aggressive, but of course it's also negative. If you want to invest in foreign countries, like many Germans like to invest in the United States. And it's really amazing that despite the fact that they put a lot of money into the United States, they feel that people in the United States are inferior, intellectually, education-wise, culturally, and so forth. That actually is not a particularly good thing. And we have, after 37 years of being in business today, we have the luxury to tell those people that they should invest with somebody else. Because you should not invest in places where you have a prejudice against the people. It's not a good thing, particularly when you exit the investment. It might have a very strong impact on the reception you get in the market. So we believe that the greatest challenge and the greatest risk is none of the ones that we have already covered, but one that we have not covered yet, and that's to find the right people. All this location stuff, location, is certainly true, but it is only partially true because locations can also change, and particularly the value for a location, even if it's the best location, might fluctuate. In fact, prime locations might have higher fluctuations in value than secondary locations. Not always, but it can happen. All our operations worldwide, and as I mentioned before, we are active on 3 continents in 11 locations, so it's a very small part of the world. All our locations have local specialists with an established network and cultural background. And these local specialists with an established background, cultural background, are not other people, they are our people. This makes also a big difference. If you control someone, not only legally, but also professionally, you have a different relationship, like a trainer of a football team. Your players, you have a different relationship with than other players. You would not use other players from another team to win your games. You might occasionally borrow one, if you can, but typically you have to have your own team. If you don't have that, and you invest abroad with other teams that might be very interested in getting your money, caution is really appropriate. The relevance of the people component in investment decision is often and always underestimated by investors. Very often they also don't have the time to build those relationships, because the companies they work for, they say, go to Singapore and buy a building. When we go to a new location, we say, let's go there and let's look around and go to the bars and go to the universities and see what's happening and so forth. That costs not only time, but a lot of money. So certain institutions haven't made provisions, neither by the factor of time, not by the factor of resources, to really build up relationships. And relationships, by the way, cannot be bought. Interactions between people can be bought. Also business deals can be bought, but relationships have to be built. I give you one example. Our operation in India, for example, managed by R.J. Prasad, who is originally from Trivandrum in India, and after completing a study as an electrical engineer with highest honors, he came to MIT and completed the course at the Center for Real Estate. And most of our managers come through this kind of conduit. They come from all over the world and take this course. So they come already with many prerequisites that we need. And we have some of the things that they need to grow their careers and also become added value to our investors. So still, even with Ajay Prasad, it took us 3 years to get to a point where we feel now comfortable to do a deal. We have turned down 3 or 4 deals that cost millions in the due diligence and underwriting. But we feel now very sure about the early decision we made that we don't want to be in a primary market. We looked at the dominant players in places like Mumbai and Delhi and Bangalore, and we are not risk adverse, don't get me wrong. We just completed a mall development with a 34-story office tower, 150, 180 million development in Turkey, and it opened up on the 29th of October, and we had 50,000 people at the opening day at the mall. It's fully leased. So the end result, of course, was positive, but it took us almost 10 years in Turkey, doing small deals in Galata, renovating old historic buildings to make friends with the population that counts, mainly the authorities and also the cultural groups and others that said, hey, I mean, this is a good company. They're doing something that we should have done. A lot of people now develop in Galata. It's too expensive for us. So similar in other markets, we think that secondary markets might be a better entry for a new investment, particularly if it's a value-add investment. However, going into secondary markets is a difficult undertaking. As I said, we're building a local team not around a deal, but around an idea. And in the long run, this is statistically proven. The mere purchase of investment-grade properties is riskier than buying value-add properties. And the reason, of course, is that, as mentioned also before by my preceding speaker, these are very interesting elements that they brought up. Energy management, home renovations. We are currently buying rental apartments in Harlem. And if you had asked me 15 years ago if we would buy anything in Harlem, I would have said very unlikely. Then we started buying in Brooklyn, and we did very well, and we realized, hey, I mean, what's happening in Harlem is what happened in Brooklyn 10 years ago. Still, these buildings are extremely difficult. They are built in 1920, and since then, nothing has happened except coats of paint. So again, you need high technical expertise and you need critical mass. Similar to what we did on Newbury Street, where we bought 28 or 30 buildings and fixed them up and so forth, and then sold them to Jamestown. The amount of expertise that went into this project is a case study, actually, a major case study at MIT. 7 minutes left. About Turkey. Interesting in Turkey, and a little easier to grasp, is the attractive demographic situation, and most economic indicators, despite many assessments in the press to the contrary, are very positive. However, investors should be careful, since the prime markets also in Turkey, such as Istanbul and Ankara, are pretty much flooded with investment capital, dumb money to a large degree. And they have experienced price increases that we cannot justify because there's no income stream that relates to such value increases. It is not easy to identify opportunities as it used to be, but we still see promising potential. In summary, our advice is to be wary in all markets, and generalizing statements towards markets, companies, and countries give investors often an overly simplified perspective along the good and bad scale. We want to be a little bit more differentiated about this. Markets are too complicated to reduce their complexity to simple correlations. That's what I tried to say. Investors are better off finding local and specialized experts who understand the investment peculiarities in each investment type, not investment location only, who understand the investment from their own experience and from having shown over longer periods of time the ability to compete against local developers. The way we figure that out, if we are good enough to compete, is that we, in a new market, want to see at least 50%, in Turkey it was 70% of the equity, which is high-risk equity, development and renovation equity, come from local investors. But not only, come from local investors at the same terms and conditions that we then offer our stable of American and Israeli and other foreign investors. So If you get to that point, then you can have a pretty good confirmation from the investment community that what you do is about as good as it gets, because that local investor, if he is the right investor, knows all the other options. You might not be at that point yet, but the investor can assess if the risk that you buy correlates with the return that you can achieve in such a investment. We should therefore not rely on economic prognosis, as they tend generally to be incorrect. The knowledge that most things happen differently than expected is of common knowledge, common value. It means a totally different approach towards investing. Market timing and picking the right horse is difficult, and the majority of investors fail at such picking. But having time in the market, not timing the market, having time in the market, as I said before, and being diversely allocated is often of great benefit. The market developments for Europe and the USA are even more difficult to predict as debt levels continue to rise. We are very concerned about that. Rising debt levels increase complexity as once the perverse over-securitization did and led to a bubble that almost crashed the whole financial system. I don't want to say it's the same thing happening now, but there are certain similarities as far as the willingness to assume risk. We should remind ourselves also that the Federal Reserve still buys 85 billion per month as quantitative easing, and all of that has to sooner or later be converted into added value in the economy, meaning more competitiveness. We are very optimistic in that respect about the United States and not so optimistic about Europe, even about Germany. The United States is in a better than ever position to become one of the most competitive and well-positioned countries, even better than some of the new markets, the emerging markets, as far as cost for goods produced, because wages in the United States have gone down considerably, productivity has gone up relatively well, and the inventiveness, the creativity is better than ever. On the other hand, a significant amount of cheap money flows into real estate. The Standard & Poor's Case-Shiller Index is rising at rates that we haven't seen since 2006. One might call this alarming. Even though the headlines in the media present you record metrics, an investor should be pickier than ever and understand exactly what he is doing. And that is something that is best to sleep over. Do I really understand what I'm doing, or do I do it because I have to move? Action bias. And right now in particular, you do not want to be overly exposed to a single market. Investors are confronted with risks and uncertainty. As a result, the excessive debt situation of the current environment involves greater uncertainty than risk. So the risk might be not growing in the same proportion as the uncertainty. Since risks are measurable, but outcomes of uncertainty are difficult to measure and may yield scenarios that are not in our scope, in times of uncertainty, we should simply stick to the old and proven concept of diversification. And again, I come back to Germany. People during the Nazi regime that understood the risks correctly, or at least better than the majority, started to diversify some of the assets into other countries such as Great Britain, and we're very thankful for that, and Switzerland and others. Taurus will continue to follow a value creation strategy in every project. We do not buy fully stabilized and investment-grade properties. We like to sell them when they're ready for that purpose. Of course, we hope for positive macroeconomic developments. However, we do not aim at increasing value speculatively, but through work and ideas. And in our company, the value of work, the property managers and many others that have to do the dirt work, is as highly regarded as the value of the creative people. And very often we get from property managers better information about leasing situations than from our leasing experts. This makes us to some extent less dependent on the macroeconomy. The work we do typically involves development, redevelopment, refurbishment, and repositioning through a value add and opportunity approach. One of the missions that fortunately I have accomplished is mission to find a partner for life. And similar in the investment scenario, many of our investors have started with us 30 years ago and still continue to invest as long as they can. But we are very thankful also that we can spread this message now to others that have interest in investing abroad, and we would encourage you to do this with companies such as ourselves. Thank you very much.
Thank you indeed. I think there were some very interesting ideas just touched on there, which are also relevant for all of us investing in markets such as Germany. I mean, I myself personally, as somebody who's lived in Germany for a while, I've often thought, everyone says real estate is about trust and relationships and so on, and that's obviously true in all markets, but I think there is something about markets like Germany which take a slightly longer view and which take things like personal relationships, personal business working relationships seriously. And I've always been just slightly uneasy with the pure Anglo-Saxon approach of, as Professor Reibling has just said, trying to pull fast ones and create money as if it is independent of the actual work that is required to make that happen. So thank you very much indeed, Professor Reibling. I think that was a very interesting and stimulating little talk. That's it for the first half. It's time for lunch for everybody. Enjoy yourselves, and we'll see us back here in an hour. Thank you very much.